What's up, everybody? According to Morningstar, housing market affordability will be restored by 2025. So how do they think this is going to happen? I mean, right now we have incredibly high home prices, still really high interest rates, and very low inventory. There's just not enough homes for sale to bring down home prices to restore affordability. Low inventory is the main source why homes are selling above the asking price, with Redfin reporting new listings down 25% from a year ago, and the total number of homes for sale down 12% from a year ago, as homeowners hang on to relatively low mortgage rates. As we move into late summer and early fall, we might see even fewer homes on the market, says Realtor.com chief economist Danielle Hale. Meanwhile, home builder confidence is up, but can builders create enough inventory to bring home prices down? In April, roughly 29% of homes for sale were new construction, according to Freddie Mac tabulations of Census Bureau and National Association of Realtors data. That was the highest share of new construction since the data collection began in 1999. Foreclosures are also up, according to ATTOM, a leading curator in land, property, and real estate data. Foreclosure filings are up 14% from a year ago. The recent increase in foreclosure filings nationwide indicates a trend that has been observed throughout the year and what we have expected to occur, said Rob Barber, CEO at Adam. This upward trajectory suggests the possibility of continued heightened activity, with foreclosure completions seeing the largest monthly increase this year. We will continue to monitor the potential impacts this may have on the housing market. But even with the rise of foreclosures, it's still not at pre-pandemic levels. According to ATTOM, there were approximately 150,000 foreclosure filings in Q1 of 2019, and there are roughly 100,000 in Q1 of 2023. So what's the plan? Today, we'll take a look at Lance Lambert's article in Fortune titled, "Morningstar Makes a Bold Call That Housing Market Affordability Will Be Restored by 2025. Here's how." To see what they are saying, let's dive right in. Housing market affordability right now is on par with what buyers saw back in 2006 during the last housing bubble, when factoring in mortgage rates, home prices, and income levels. After home prices went up over 40% during the housing pandemic boom, and then Jerome Powell started to raise interest rates again and again to now it's almost around 7%, it's basically impossible to afford to buy a house. According to Redfin's latest housing market update, the average sale to list price ratio hit 100.1% during the 4 weeks ending July 2nd, marking the first time in nearly a year the average U.S. home is selling above the asking price. In Lambert's article, he talks about 3 levers that can help to ease housing affordability heading forward: falling mortgage rates, falling home prices, or rising incomes. And due to financial market volatility, mortgage rates are always the lever that can have the biggest impact in the short term. As of last Friday, the average 30-year fixed mortgage rate tracked by Mortgage News Daily was 7.14%. In Morningstar's latest housing reports, they expect mortgage rates to trend down in the second half of the year, averaging 6.25% for 2023. Morningstar's forecast model then expects mortgage rates will average 5% in 2024, followed by 4% for 2025. The Fed has engineered a massive increase in interest rates in order to combat high inflation. We expect it to cut the federal funds rate aggressively in the coming years, driving the federal funds rate down from 5% currently to below 2% by 2025, wrote economists at Morningstar. Once the Fed wins the battle against inflation, its priority will shift to jump-starting economic growth, which will require much lower interest rates in our view. Long-term, Morningstar expects rates to remain low. They say factors like an aging population and slowed productivity growth that'll put downward pressure on long-term rates, like mortgage rates. Regardless of what happens in the next few years, we expect rates to ultimately settle back down at the low levels that prevailed before the pandemic. The low interest rate regime will resume once the dust settles from the pandemic economic volatility, wrote Morningstar. Our long-term interest rate projections are driven by secular trends. Factors such as aging demographics, slowing productivity growth, and increasing inequality have acted to push down interest rates for decades. And these forces haven't gone away. Economics over at Morningstar also expect the other two levers to help out: rising incomes and falling home prices. Our revised home price forecast now projects new and existing home prices to decline 6% and 4% over 2022 to 2024, respectively, wrote economists at Morningstar. They call their prediction a mild correction, adding that a steeper decline in home prices would be prevented by the fact that inventory of existing homes for sale remains below pre-pandemic levels. When compared to the other forecasters, Lambert points out that Morningstar is on the low side when it comes to mortgage rates. Heading forward, the Mortgage Bankers Association and Fannie Mae expect the average 30-year fixed mortgage rates to end 2023 at 4.9% and 5.6% respectively. Moody's Analytics expects mortgage rates to drift down to 6% by the end of 2024 and to 5.5% by the end of 2025. On the home price front, Morningstar is on the bearish side. Firms like Zillow and CoreLogic think that home prices will rise 5% and 4.6% respectively over the coming 12 months. Moody's Analytics doesn't even think the bottom is in and expects peak to trough declines of around 8% for national home prices. According to Redfin's latest housing market update, for the 4-week period ending July 2nd, home sale prices declined in 22 metros, with the biggest drops in Austin, Texas, down 9.8% year over year, Las Vegas down 7.6%, Detroit down 6%, Oakland, California down 5.9%, and Fort Worth, Texas down 5.7%. Sale prices increased the most in Milwaukee, up 11.2%, Providence, Rhode Island, up 8%, Newark, New Jersey, up 6.3%, Miami, 6.2%, and West Palm Beach, Florida, up 5.5%. Nationally, 36.8% of homes sold above their asking price. That's the highest share in 10 months, but it's down from 51% from a year earlier. And on average, 5.6% of homes for sale each week had a price drop. That's about the same as the 5.5% rate from a year ago. It's such a mixed market, with some places seeing price drops while others are seeing homes selling way above the asking price. The only way the market is really going to become balanced is if we see more inventory come on the market. And the fastest way to do that is to lower interest rates so those sellers that are holding on to their low mortgage rates will put their homes on the market. I'm just not sure that's going to happen anytime soon. Redfin reports new listings of homes for sale fell 24.7% year over year, one of the biggest declines since May of 2020. And active listings dropped 11.6% from a year ago, the biggest drop since April of 2022. And the months of supply, which is a measure of the balance between supply and demand, was 2.6 months, nearing the lowest level in a year. So what do you guys think? Do you think Morningstar is right? Do you think interest rates will be 4% by 2025? Definitely comment below and tell us what you think. If you missed last week's video on the housing market's biggest problem, definitely check that out next. Thanks for watching. I do appreciate it. Bye.